The seniors housing market has been in need of debt capital for at least the last 12 to 24 months, given everything going on in the banking world and credit crisis. And I'm here with Kathryn Burton Gray, who's the Managing Director of CIT Healthcare. And CIT is back in the market, is in the market looking for senior housing loans, good quality providers. Since your parent company's restructuring last year, what's been the major focus of the healthcare group, and specifically in the seniors housing market?
The focus has been in what we've done best, which has been the skilled nursing, the assisted living. Really didn't do much in the independent living. So the restructure aside, we're still looking at the same type of products that we've been doing in the past.
Okay, so nothing...
Probably just more strategically with the borrowers that we have. We have some good relationships. We'd like to maintain that. We'd like to introduce some new relationships, but within the confines of skilled and assisted living is really our...
So no independent living, no CCRCs?
No, we'll look
dementia.
at some dementia. I like that product a lot.
Okay.
But skilled is something that we do really, really well.
Can you tell us anything about some of your recent lending activity?
Yes, actually. We just closed a rather large transaction on Friday, and we're very happy to be part of a bank consortium that did the transaction. It's a very large one. It's over $500 million, and it's a new relationship for us, although a lot of the operators within that the transaction are well known to us, and we've had some relationships with in the past.
So that gave you comfort in joining the syndicate of banks?
Plus, I think the other lenders that were involved in the transaction gave us a lot of comfort.
So now that with the restructuring, now that you're a full-fledged commercial bank, are you going to be doing all balance sheet lending? Are you going to be looking at any kind of agency stuff, or just the balance sheet lending?
We're going to be looking at balance sheet lending, but we will be looking at transactions directly with our borrowers, and possibly some participation, some club. I don't want to say participations. I would rather say club transactions. Maybe a small consortium of banks.
Yeah, well, that's good to hear you're doing balance sheet lending, because everyone else is talking Fannie, Freddie, and HUD. So the more balance sheet lending we can get out in the market, I think it'll be better for the industry. And on your loans, are you looking more at a fixed rate or floating rate? What kind of structure do you prefer?
You know, we have the capacity to do both fixing and floating. I actually like the floating a little bit better, just because I don't think borrowers like paying defeasance if they want to get out of the transactions early. I think it really gives them more flexibility to do more of the floating rate transactions.
And do they like floating now because also floating tends to be cheaper given where they're based off of?
Yes, but there's also LIBOR floors that the lender makes sure that they get a return.
And what kind of term for your loans are you generally trying to do on the balance sheet?
Probably like 5 years. 3 to 5 years is typical. Although even with 5-year deals, a lot of them are paying off early, and I would say 24 to 36 months is what I'm saying.
Okay. And any difference in term and rate that you charge for skilled nursing versus assisted living? Because I know your background is more, you've done a lot on the skilled side.
No, there isn't really obviously the risk profiles are different, and then we take that into account when we're pricing a transaction. But, leverage is really important, and whether it's an assisted living or a skilled, we want a certain amount of leverage in the transaction that we'd be comfortable with.
And are you kind of looking at the new normal of 70%?
Yes, I saw that, yes. I would say 60 to 70, 75 is on the higher side, is probably the leverage that we feel most comfortable with.
Okay. And I realize, 2010 was a transition year for you guys. 2011 is, what kind of loan volume are you targeting to do in seniors housing?
Right, I think
care?
We're looking at anywhere from $100 million to $200 million for 2011. I would say that 2010, as you had stated, was a transition year, particularly for CIT. I think it's also for the industry as well, because the transactions that I'm seeing getting done have been mostly agency transactions. So I'm starting to see more balance sheet lenders out there, and it's kind of a walk, not run. If the transaction makes sense, obviously the underwriting standards have changed, more conservative. We want more equity in the deal. We want proven operators. I think that's always going to be important, and I think it's important now. Trying to do turnaround transactions are going to be very, very difficult. We don't want to take any kind of pro forma risk, And I think you're going to see other lenders.
But with so few lenders out there right now, and specifically so few banks doing balance sheet lending, is your demand way in excess of that 100 to 200 million in terms of people calling you up, you calling people?
There is more deals are coming online now that I'm seeing, but they fall into really two categories. Either the very large transactions or they're smaller, more regional operator transactions. Is there going to be enough capacity to do that? Yes, there is. You just have to pick your spots. Mm-hmm. You're going to have to make sure it's the right transaction for your institution, and that's what we're being more selective.
And how do you like the competitive field for you now, especially with fewer lenders out there and you coming back?
I think it's a great time.
Spot.
I think it's a great time for us to be in the industry where, we have to be bank compliant now, so we meet the same standards as a lot of the banks, but we don't require, like a lot of the banks want depository relationships or they can't do the transactions. Right. We're not in that camp right now, so that gives us a tremendous amount of flexibility.
Yeah, I think, well, I'm going to guess a lot of that was they're repairing themselves and they need to make money in many different ways besides just the loan. So
absolutely, because the loans were lost leaders for them in
right.
a lot of cases.
Right. Okay.
It was more of the relationship.
All right, well, I'm glad you're back in the lending business.
Thank you, Steve.
I hope you hit the 200 million mark next year and can maybe get above that after that.
Great.
Thanks for sitting down with me.
Thank you.